An important learning from the Japanese samurai is never to stray away from a set strategy. In the prevailing scenario, there is likely to be a lot of heightened volatility emanating from global markets. Hence, it is important to follow the way of the samurai, namely to maintain discipline to your investment charter, asset allocation, and deployment strategy, which is essential for long-term wealth creation. A carry trade occurs when investors borrow money in a country where interest rates are extremely low and invest that money, after converting the currency, in a country where interest rates are relatively much higher. The yen carry trade is a classic example. After keeping interest rates close to zero for a long time, the Bank of Japan, BOJ, raised its target interest rate to 0.25% recently. This has led to some unwinding of the yen carry trade and is likely to lead to high volatility in the short term for risk assets like equity. The recent jobs market data from US is raising concerns about a slowdown in the economy. Global markets now expect the US Fed to begin rate cuts starting September 2024. While global volatility is likely to impact domestic markets, the Indian equity market is fundamentally robust given the superlative earnings growth over the last 5 years. If we consider valuations of the Nifty 500 companies, ex of financials, the ratio of enterprise value to cash flow from operations suggests that valuations are still reasonable despite market levels at all-time highs. With improving capacity utilization, return on earnings is likely to trend higher. Large caps are trading at relatively better valuations versus mid and small caps. The temperature gauge index is in the fair value zone. Despite short-term volatility, the long-term outlook for Indian equity markets remains positive. Based on their risk profile, investors having the appropriate level of equity allocation can continue to remain invested. If equity allocation is lower than desired levels, investors can increase allocation by implementing a staggered investment strategy over 6 months for large cap and multi-cap strategies and 6 to 12 months for select mid and small cap strategies with accelerated deployment in the event of a meaningful correction. The Union Budget 2024 has reconfirmed the path to fiscal consolidation. The fiscal deficit for FY25 is set at 4.9% of GDP with a goal to reduce it below 4.5% by FY26. The RBI is likely to maintain interest rates at current levels for most of calendar year 2024, considering inflation and growth dynamics. The rate cut cycle is likely to begin early next year. The yield curve has moved lower at the short end and is gradually steepening as compared to the curve seen at the end of FY24 on back of favorable demand-supply dynamics and well-contained inflation. As per the budget proposals, the change in taxation for multi-asset allocation funds makes these strategies a must-have in traditional fixed-income portfolios. We reiterate our view to have a duration bias in the fixed income portfolio so as to capitalize on the likely softening of yields in the next 1 to 2 years. 30% of the portfolio should be invested in actively and passively managed debt strategies to capitalize on duration. 30% to 35% of the portfolio should be allocated to multi-asset allocation funds and equity savings funds. These funds aim to generate enhanced returns than traditional fixed income with moderate volatility through a combination of domestic equity, arbitrage, fixed income, international equity, gold and other commodities. To improve the overall portfolio yield, 30% to 35% of the overall fixed income portfolio can be allocated to private credit strategies, REITs, InvITs and select high-yield NCDs. For liquidity management, investments can be made in floating rate and arbitrage funds. Gold is continuing to witness global central bank buying. Gold should be treated as a hedge against high volatility and should be part of strategic allocation.